Okay, welcome everyone. My name is Tony Zhang. I am the Chief Strategist here at Options Play, and today we're going to be doing a webinar. We're going to be talking about leveraging technical analysis with options trading. Now, this is one of my favorite topics because I have spent almost 13 years of my life as a market strategist helping people with technical strategies and then leveraging those strategies into options. So this is a really passionate topic of mine, so I'm really happy to be here and share this information with you guys. Just a little background, we're going to be talking about different techniques of technical analysis. Then we're going to show you how to leverage those into specific options trades. Now, this webinar is for those of you who have some experience trading options. So before I get started, just please type yes into the chat window if you have traded options before, and please type no if you have never traded options, just so I get a feel for who is in the room. Okay, so I have about half yeses, half nos. Okay, so for those of you that are brand new to options, welcome. I will talk a little bit about the basic option strategies that we'll be looking at, and I will talk you guys through the different forms of technical analysis and kind of showing you why different strategies are suitable for different forms of technical analysis. You know, technical analysis, for those of you that are unfamiliar, is really using charting to help you decide what stocks to buy or sell. So today what we'll do is I will spend about 15 minutes going through the slides, showing you different forms of technical analysis, walking you through what they mean. And then, like I said, what I really want to do is spend the time actually showing you some real examples of setups with specific stocks and showing you, number one, why we're looking at these specific stocks from a charting perspective, and more importantly, how can you leverage them quickly into an option strategy. And that's really what Options Play, the tool that we'll be showing you here today, is designed for, is to allow you to find an idea and quickly leverage that into an options trade. So today we're going to be talking about just a quick intro to technical analysis for those of you that are brand new. Then we're going to cover what are the basic option strategies you can use for technical analysis. Then what we'll do is we'll cover 4 different major areas of technical analysis. So it's chart analysis and patterns. For those of you that are familiar with technical analysis, this is things like support and resistance, head and shoulders, these types of patterns that you would typically see. We'll look at chart overlays, things like moving averages, Bollinger Bands that you might be familiar with. Then we'll take a look at some chart indicators. This is probably where many of you have spent a lot of time researching things like RSI, MACD, stochastics, these types of indicators that provide overbought, oversold conditions. We'll take a look at some of those. And then lastly, we'll take a look at market analysis. So generally, what type of market analysis you can use with technical analysis to help provide guidance in terms of which direction you want to trade in. And lastly, like I said, we will be using Options Play to show you these examples that we're going to teach you today, as well as show you how you can quickly find option strategies based on the technical analysis that you're going to learn here today. So with that, let's just go ahead and get started. What is technical analysis? It's really simple. Technical analysis, what I have spent the last 13 years of my career working on, is really forecasting future prices based on past chart movements. And what this allows us to do is really look at the historical charts, and from studying those historical charts, it gives us an idea as far as, or to anticipate, what is likely going to happen in the future. And the key word here is likely. There's no crystal ball that anyone has. We're simply trying to say what it has a higher probability of happening based on historical patterns. The good thing about technical analysis is that it's applicable to all tradable instruments. So once you learn charting, you can use charting on stocks, you can use it on currencies, you can use it on commodities, bonds, whatever you can chart, whatever you can trade, you can use technical analysis for. And that's really one of the key tenets of technical analysis that I love, because I like to trade different markets. Now, if you're a fundamental trader in equities, that knowledge that you have with reading balance sheets and income statements, that doesn't translate over to trading bonds or commodities or foreign currencies. So that's really why I like technical analysis, because of how flexible it is across all asset classes, not just one single one. So when you're a technical analyst, it's important to understand the mindset of a technical analyst. And the best way to describe it is that technical analysts care about what is simply more important than why. And the reason for this really is because technical analysts believes that markets are efficient and that price reflects everything. What I mean by that is, for example, when a news announcement comes out, you typically see a reaction in the market pretty much instantaneously. There's no delay in terms of market ingesting that news and reacting to it. That reaction happens instantaneously, which means that if you don't have access to that data beforehand, it's almost useless to have that data. So we don't really care why something moves. We just care about what happens to that asset or what happens to that stock after something happens. And that's really much more important. So that's what I'll show you guys here today is stocks reacting to certain things and understanding that how that reaction helps provide you with guidance as to what might possibly happen in the future. And this is all because price discounts all information. Meaning there isn't, a lot of people will read a news article and try to trade based on that news article, but chances are that news article may have been a few minutes or maybe even a few hours old. So the markets have moved on since then, or at least have reacted to it already. So it doesn't really matter that the markets have reacted. The question is just how did the markets react? And that's really what charting tells you is how did the markets react to this specific news or event? And that helps provide you with guidance as to what may happen with that stock in the future. And lastly, technical analysts do not believe that markets are random, meaning we don't believe that history repeats itself, but we believe that history certainly rhymes. So when certain things happen in the past, we generally believe that they will follow a similar pattern going in the future. So those are the major tenets and thought processes of a technical analyst. So when you combine technical analysts with option strategies, this is really where I find the most use for technical analysis when you're trading options. Number one of the greatest thing about trading options, and this is true regardless of what type of analysis you do, is that you can limit your risk using options. A lot of people have thoughts that options are risky, but in reality, options actually help you limit your risk because many strategies that you can buy, such as buying a call or a put, buying a credit spread, buying a debit spread, all of these types of strategies have limited risk. So your risk is completely defined before you enter your trade. And no matter what happens to the stock, your risk is limited to what you've paid for that option. And that's really one of the best parts about trading options. If you look at successful traders, they're not necessarily very good at picking stocks or figuring out strategies. What they're really good at is managing risk. And options allow you to manage your risk very, very easily because what you pay is what you risk. You can't lose more than that. And that's really one of the key pieces. So what I'm going to do here is I'm going to break it down into two different forms of trading when it comes to technical analysis and show you what types of option strategies make sense for that specific type of analysis. So when it comes to charting, the great thing about charting is that it not only does it provide you with levels, meaning price levels to look at and react to, which provides entry points and exit points. It also provides timing, which is particularly good for option strategies. However, not all technical analysis will provide you with clear exit prices and clear timing. So it really depends on the type of analysis. And that's what we're going to spend some time going through today. So what I have here is I have two sections. Number one, technical analysis, where you have a clear entry price, but you have an unclear exit price, meaning you have a clear entry price, but you're not quite sure what the target is. So for these types of strategies, there's two strategies that typically make sense. Either buying long calls or puts. This is the most simple of option strategies that you can do. Calls and puts allow you to take bullish or bearish exposure with unlimited upside potential with limited risk. And you should typically buy calls or puts when you expect a quick and fast move in the underlying stock. So we'll go over a few different examples of what type of technical analysis will provide this type of quick or fast move viewpoints on an individual stock. The second strategy that you can use when you're trading a stock where you have a clear entry price, but you may not have a very clear exit price, is selling credit spreads. Credit spreads are more so for when you expect a neutral or a small directional move. So we'll also cover what types of technical analysis will provide you with this type of outlook. And then lastly, there are many different forms of technical analysis that give you a very clear entry price and a clear target or exit price. So for these types of strategies, it's best to consider using debit spreads. And debit spreads provide you bullish and bearish exposure when you expect a modest directional move in one direction or another, or a clear directional move in one direction or another. So those are the three primary strategies that you would deploy when you're trading using technical analysis. And here's the three of breaking it down into kind of which one you're going to use. So I'll actually use some real examples to show you each one. So let's go ahead and get started and look at the different forms of technical analysis. So the most basic form of technical analysis is what we call chart analysis. This is simply just looking at the chart and saying, what is the chart doing? And traditionally, when we're talking about chart analysis, we're looking for things like support and resistance and trend lines. And this is by no means an exhaustive or a comprehensive look of technical analysis. If anything, we're just scratching the tip of the iceberg here. So I'm just giving you some of the beginners, or what are the major use cases of chart analysis. So support and resistance and trend lines. So support and resistance refers to some of these dark arrows here at the bottom. As you can see, this stock hit this 33 level, bounced higher, hit this 33 level again, bounced higher, hit that 33 level, bounced higher. This is what we consider support. Resistance is basically vice versa. As you can see, it rallied up to this 42 level, sold off. Rallied up to this 42 level, sold off. Rallied up to the 42 level again, sold off. So we would consider that a resistance level. Now, the good thing about trading support and resistance and trend lines is that it provides very clear entry and exit prices. So there's two ways you can trade them. You can trade them using debit spreads. So for example, if you're at the support level, let's say you're here at the support level and you think it's going to go back up to that resistance level, you can buy a call, roughly around that support level, and then sell a call near that resistance level. And that's how you can trade a debit spread. The other way you can trade this is you can simply trade a credit spread. And this is really where you may simply feel that the stock is it's reached the top, but maybe you're not sure that it's going to go all the way back down to 33. You just think that it's not going to continue going any higher. If that's the case, you can sell a credit spread. You can sell a $43 or $44 call and then buy back a higher call, a $47 or $48 call. That will basically help you limit your risk. So those are two ways that you can use credit spreads or debit spreads to trade when you feel that a stock has hit a support or a resistance level. I have some real examples to show you guys in a few seconds using options play, but this is just for illustrative purposes to show you what support and resistance means and what type of strategies you would deploy based on your views for that stock. Second part of chart analysis is looking at a very popular form of chart analysis is what we call breakouts or breakdowns. So this is basically when the stock is trading within a range and all of a sudden either breaks higher above that range or breaks below that trading range. So here we have an example of a breakdown. As you can see, this stock was trading in this range between 60 and 65 for quite a bit of time, for quite a few months, and then all of a sudden it has a very severe drop. It breaks below that level and then has a very severe drop. Conversely, the stock then trades in a very tight range for a period of time between 42 and 48 or so for a couple of months, and then it breaks higher. So this is a breakout. Now, these types of strategies, because you have a clear entry, because you know exactly where its stock starts to break down, but you don't have a clear exit, meaning when the stock breaks down, you don't really know how far it's going to go down. And when it breaks out, you don't really know how far it's going to go higher. And these moves tend to be very quick. These are quick, fast moves. And because of that, you typically want to buy calls or puts. If you want to buy a call, if you think the stock's going to go higher, you want to buy a put if you think the stock's going to move significantly lower. This provides you with quick exposure both to the upside and downside, allows you to take unlimited upside potential for these quick moves up or down. The one thing that I will say is that breakdowns typically move faster than breakouts. So as you can see, this breakdown happened very, very quickly. A single bar was a huge move versus this breakout, simply wasn't as large. And this is just the nature of markets, is that the big moves tend to happen more so to the downside, meaning there's typically a higher likelihood of a stock dropping a significant amount than the probability of the stock moving higher a significant amount. So just keep that in mind. So when you're doing breakdowns, very likely you'll be just buying puts. On the breakout, you can buy calls, but you can also consider trading a debit spread sometimes, because the move in a breakout sometimes usually isn't as fast as a breakdown. Next, I just want to take a look at gaps. So these are common and breakaway gaps. These are very common as well. I have a few examples, like Chipotle recently had one of these breakaway gaps. This is very similar to the breakouts. They give you a clear entry price, but they don't give you a very clear target price. So once the stock breaks out, you don't really know how far it's going to go higher. You don't really know how fast it's going to go. So usually calls and puts are good for these types of strategies, because you typically get a quick move higher, and they many times can go on for quite a bit of time. And there isn't a really good way to determine how far it'll go. So that's why buying calls and puts, generally speaking, are good for these types of strategies. Next, we'll look at chart patterns. Chart patterns become easier to identify the more charts you look at, and I highly recommend, there's many resources that you can go on the internet, such as stock charts. They have a technical analysis school. They teach you a lot of these different patterns, and there's so many of them, I can't go over all of them, but these chart patterns typically are what we call reversal patterns, meaning they typically tell you when a stock is about to reverse direction. So a double top or a head and shoulders is a good example of this. This gives you two things. Number one, a very clear entry. However, the exit typically is unclear. So you have a double top. That means the stock will likely no longer continue going any higher. It's now going to reverse lower. The question is, how far lower is it going to go is typically unclear. So one of the better ways to trade this is actually using credit spreads, because credit spreads allow you to basically say, I don't think the stock's going to go above a certain price, or I don't think the stock's going to go below a certain price, and be able to profit as long as that happens. So you can buy calls or puts if you expect a huge move. Otherwise, you can trade credit spreads if you expect a more modest move, or you simply just don't think the stock's going to continue going any higher or any lower. The second type of chart pattern is what we call continuation patterns. So continuation patterns are things like flags and pennants. These are typically, what you get is a stock moving in one specific direction and then trading sideways in a specific range. And this range could either be sideways, it could be slightly moving lower, it could be kind of flat. But basically what ends up happening is you have a stock that rallies significantly, it consolidates for a period of time, which is very normal for stocks to do before it continues going higher. Now, the cool thing with flags and pennants, or these types of continuation patterns, is that you have clear entry and clear exit, or clear targets, because the move that happens before it enters this flag is usually the same size as the move after. So as you can see, the stock moved roughly $10 to rally into this flag. Then as it kind of traded sideways from that flag, once it broke out from that flag, it moved another $10 higher. So because you have a clear entry and a clear target price, these types of technical patterns are great for using debit spreads, because they allow you to take this bullish view with even smaller amounts of risk than simply just buying a call. So that's why using debit spreads many times are some of the best ways to utilize these types of continuation patterns. Next, I have things like chart overlays. So any of you that have ever looked at, that have watched CNBC or watched anyone talk about moving averages or Bollinger Bands, these are what we call chart overlay strategies. Now, there's many different use cases of these. There's so many different moving averages. So there's so many different ways you can use moving averages, and there's so many ways that you can use these Bollinger Bands. I don't have enough time to get into all of them. However, once you learn about these types of chart overlay strategies, you'll see that they typically give you a clear entry point, but they don't give you a target price, meaning you have no idea how long the stock could be in that trade for. It could be in for 2 weeks, it could be in there for 2 months or 2 years. That's the unclear thing about these types of chart overlay strategies. So generally speaking, you want to trade calls and puts if you expect the move to happen fairly quickly or severely. If you feel that the move is going to happen more slowly, credit spreads may be more useful for these types of trades. Now let's take a look at some chart indicators. So for many of you that have used technical analysis, these are your traditional oscillators that you'll see below the chart. The typical ones are like RSI, MACD, stochastics, and there's a whole slew of them. There's probably at least 100 of them that people use, and people use them in all different types of use cases. However, they're all generally meant to tell you roughly the same thing. They're generally either going to tell you that the stock is oversold, meaning that the stock is severely sold off and is likely going to reverse and move higher, or it'll tell you that the stock is overbought, meaning it's clearly had a huge uptrend and is likely going to either reverse or at least not continue going any further. Now, what this does is that, generally speaking, when you know that the stock is overbought or oversold, what it does is it does give you a clear entry because it tells you exactly when the stock is oversold or exactly when the stock is overbought, but you don't really have a clear target. So as you can see here, when the stock rallies from 44 up to about this $50 level, we get the reading that the stock is overbought. And what that tells us is that the stock is unlikely going to continue moving higher. That doesn't necessarily mean that it will reverse, but it simply means that the stock is unlikely to continue going higher. So as you can see, the stock trades quite sideways for a period of time before it moves slightly higher again, reaches overbought again. Simply says the same thing. Now that we reached that 52 level, it's basically saying we don't think it's going to continue going higher. As you can see, the stock kind of trades sideways. And then again, it moves up to 54, same thing, overbought, and the stock trades sideways. And lastly, one last time when it reaches 58, it's also overbought. This time it kind of breaks the camel's back and the stock starts to reverse, but that's never guaranteed. What overbought, oversold means is that it's unlikely going to continue in that direction. So because of that, we generally want to use credit spreads when we're trading with these chart indicators, because we're only simply saying that we don't think it's going to move in one direction. It doesn't mean that the stock is going to reverse. If you feel the stock's going to reverse, you might want to trade a debit spread. But generally speaking, with these chart indicators, that's not very reliable in terms of telling you that it's going to reverse. They're more reliable in telling you that it's simply not going to continue going much higher in one direction or another. Same thing with, this is just another indicator, very similar to the last one I showed you. Same thing, it's meant to tell you when the stock is overbought, when the stock is oversold. And again, when you get these green arrows, that means it's oversold. When you get these arrows, that means it's overbought. And again, if you use these arrows as entries, then these are good times to consider selling credit spreads, because as long as the stock doesn't continue moving higher, or if it moves lower, you will actually make profit when you're selling your credit spread. So we'll show you some examples of that using options play. Lastly, I just want to cover some market analysis. This is typically what many people will use to generally analyze the markets as a whole. So these are things like relative strength of the stock, telling you how strong the stock is, and we'll show you that in 1 second using options play. Things like net 52-week highs. So the ratio of 52-week highs to 52-week lows gives you an idea as far as how bullish or how bearish the market is. And things like just intermarket analysis. These are the type of market analysis techniques that many people will use with technical analysis. And the one thing I want to point out is that none of these are signals. You should only use them as confirmation for any of the techniques that we just showed you before. So if you're looking at a double top and you see that 52-week highs are starting to drop off and they're starting to see more 52-week lows, that's just a confirmation that it's likely the market's going to start pulling back. Or if you're looking at relative strength is starting to fall off, these are used as confirmations. These should not be used as signals themselves. And typically you want to use the top-down approach. So when it comes to market analysis, or whenever you're picking a stock, you want to try to use the top-down approach as possible. Meaning if you're looking at a stock that's bullish or bearish, you want to make sure to look at the sector as well as the market to see if they line up with your views. So for example, if you're looking at a bearish stock, you typically want to see, is this stock currently in a bearish sector? If it's in a bearish sector, then you might want to see, is the current market bearish? Because if all of these three things line up, that will give you a higher probability that the stock you're looking at will move lower. Because if you're looking at a bearish stock, but the sector is bullish and the market is bullish, there's a more likelihood that the whole market might actually drag the stock higher, even though the stock itself is quite bearish. So just keep those things in mind, because when you line up the market, sector, and stock, you're going to get higher probability trades in one direction or another. So with that, let's take a look at options play and actually show you guys some real examples. So for those of you that are brand new, welcome. If you haven't seen options play before, you can find it under the trading tab under your options section. And when you click on this button here on the right called Options Wizard, that's how you can launch options play and actually see it in action. This is a free tool that's available to you guys, so I highly recommend for you to log in and check it out. It is designed to really help facilitate options trading and make it as easy as possible. Now, if for any of you that currently trade options, you might be trading options using the option chain, so you might be familiar with the page that looks like this. I certainly learned how to trade options using a page like this. However, I will say it is kind of a pain sometimes to try to figure out which expiration to trade, which strike price to trade, especially if you're looking at spreads like debit spreads or credit spreads. It's really difficult to analyze them sometimes using this type of page because you get even more numbers when you're looking at the spread. So what we really wanted to do is create a much more user-friendly way of analyzing these types of strategies that also show you the historical charts so that you can actually see everything before you place your trade. So I have a few different examples here. We covered support and resistance levels here before. So I want to take a look at some stocks like, let's see, HRB, H&R Block. And one thing I want to point out is that all of the examples that I'm showing you here today is simply for illustrative purposes and educational purposes. This is by no means a recommendation or advice or solicitation to trade any of these stocks or options. I'm simply using these stocks as an example to show you guys what I'm currently seeing in the markets. Please don't take this as advice or recommendations. So I was looking at H&R Block today, and I saw that H&R Block really has been hitting this 28, 29 level and bouncing off every time it hits it. As you can see, it rallied into this level back in December, bounced off of it. Same thing happened in late December, bounced off 28.5, reached 28.5 again in January, bounced off. Same thing again here in February and over again. So, and now we're back up here to this 28.5 level. So it wouldn't be too crazy for someone to say this stock has bounced off this 28.5 level so many times that it's very likely going to happen again. And if that's the case, one of the things you can do is instead of, one of the coolest things about our platform is you can say, hey, I'm bearish on H&R Block because I think the stock's going to move lower, and we're going to show you 3 bearish strategies here on the right. So this means that you don't have to pull up a chain, you don't have to pick an expiration or a strike price. We're already showing you some bearish strategies that make sense for a bearish view on H&R Block. So there's 2 ways you can interpret this. You can either say every single time it hit this 28 level, it made a quick move down very quickly after that. So I think that same thing's going to happen. Or you can say, I think it's not going to go above 28.5. So I think it might move a little lower or maybe move sideways. I don't think it's going to move much lower. So those are the 2 different views that you can have. So as you can see, we have these 3 strategies here on the right. You can short the stock, you can buy a put, which is a simple strategy, or you can buy a put vertical, which is the debit spread that we were talking about. And what we can do is we can say, well, H&R Block's at 28.5 right now. What happens if I think the stock's going to go back down to, let's say, 26? So if the stock goes down to 26, here, if you had shorted the stock, you make a 3% return. If you bought this put, you make a 100% return. If you bought this debit spread, you make a 160% return. So this allows you to say, what happens if I think the stock's going to move down, what my potential profit is, or what happens if I just think it's not going to move any higher? So as you can see, if the stock stays where it is, I'm actually going to lose money on the put and the put spread. So one of the things that we talked about is using a credit spread. So one of the things you can use is use our strategy constructor. You can set up a short call vertical, which is the credit spread, and say, what happens if I sold a credit spread? As you can see, if you sold a credit spread in here in this condition and the stock stays where it is, you actually make 100% return, or you keep all the credit that you receive from selling that credit spread. So here are 3 different ways that you can play H&R Block based on your views for the stock. And what we do is we provide you with all the analysis so that if you want to trade this, you know exactly what the max risk, max reward is. We even have a strategy checklist. As you can see here, it doesn't actually look very good, so you might not want to place this trade. But if, let's say, you wanted to place, let's say, this debit spread, even though some of the warning signs here is telling you that you might want to reconsider, one of the coolest things about our platform is that you don't have to enter these trades manually. You can simply hit the preview order button, and we will actually fill out the full ticket for you. So you don't have to fill them out, and this reduces your chances of making a mistake when you're filling out these order tickets, because there are a lot of parameters, 1, 2, 3, 4, 5, 6 parameters per leg. So if you're doing multi-leg options, you have to enter 12 different parameters. Sometimes it's easy to screw something up, flip buys to sells, or flip, the expiration dates, or flip the strike prices, and next thing you know, you're in a completely different trade. You can avoid those types of mistakes when you're using options play, because when you're using options play, you can see exactly the trade you're about to place. You know exactly what the risk to reward is. You can see the direction of it. And once you're ready to place a trade, hit the trade button, preview order, and it's off to the races. Next example I have here is Apple. This is a breakout stock. This is a stock that recently, as you can see, it moved higher. This is kind of a continuation pattern that we've seen, right? So it moved from about 162 up to about 190 or so, and then traded sideways for quite a few weeks before just a couple of days ago started to break out. So one of the great things about these types of continuation patterns is that we can measure the move that had happened from before it entered the pattern. So here it went from about 162 to 190. So that's almost a $30 move. So we can say, what happens if we think the stock's going to move another $30 higher? So that's really where trading a debit spread comes into play. So you can say, what happens if the stock's at 192 right now? What happens if it hits 210? If it hits 210, as you can see here, we'll show you 3 strategies again on how to take advantage of Apple. This way you don't have to pull up that option chain and try to figure out which expiration or which strike price to choose, which sometimes can be really daunting to try to figure out what expirations and strike price. Here it does that for you, or at least provides you with starting points so that you can do some analysis first before you can still make adjustments further, but it gives you a starting point. So if the stock's trading at 193 right now, you think it's going to move to 210. Here, if you bought the stock, you make a nice 8% return. But if you bought this calls option, you'd actually make 173% return versus buying this debit spread, you only make 140% return. So this allows you to actually compare different strategies side by side and say, in this particular instance, I might be better off trading that call. It's a little bit more expensive, but it gives me upside. So I'm expecting Apple to really take off here. So taking that call option really allows me to give me that exposure. Just for an extra $100, it might make sense to get that extra exposure. So this is really why you want to use these types of tools to analyze your options versus just looking at the option chain, because you don't get that type of analysis when you're looking at the chain. You can't compare one strategy to the next and say definitively which one gives you the best risk to reward, versus options play can allow you to put 2 strategies side by side, say wherever you think the stock's going to go. Let's say you don't think maybe you're not as bullish and you think it's only going to go to 203. Then, as you can see here, you make a 5% return on the stock, a 78% return on the call, but 108% return on the call spread. So if you're not as bullish on Apple, maybe you're better off trading that call spread. This P&L simulator allows you to definitively say which one's best suited for your given outlook for the underlying stock. Let's take another look at another example here, Chipotle Mexican Group. This is a stock that I don't specifically have a trade on, even though this is a stock that's starting to break out. However, what I really wanted to highlight for you was this breakaway gap. So as you can see, before that date, the stock really kind of was trading slightly higher, but mostly in a sideways range between 320, 340. It reached this 310 level back in February, moved up to 340 in March, came back down to 310 again, moved back up to 340 and a little lower, and then it just broke out all of a sudden. So this is the typical breakout trade that you would make. So if you were actually trading this on April 27th, you might consider buying a call, because these types of breakouts will typically yield quite a bit of a move afterwards, which is what we're seeing right now. Over the month or so, it moved from 419 to about 450, about a $30 move. And then now it's starting to break out again. So this is a potential time to look at Chipotle Mexican Group as a breakout trade again. So it moved up to 450, came back down, now broke above 450. So maybe you might want to take a look at buying a call or a call spread. Perhaps, you want to take this measure move of 415 to 450. That's about a $35 move. So what happens if Chipotle moves up another $35 to 485? So here, as you can see, if you have bought the stock, you make a 6% return. If you bought the call, you make a 62% return. If you bought the call spread, a 108% return. And what if you're wrong? What if the stock drops? What if it goes back down to 410 or 415? Here, as you can see, if I had bought the stock, I'd actually lose $4,800. If you bought 100 shares of the stock, you lose $4,800 if you're wrong. If you bought the call option, you lose $2,600. And if you bought this vertical, you actually lose only $1,600. So you're actually risking less than when you're buying that stock. And if you're correct, you're making a substantially larger return on your investment when you're trading these types of spreads. And that's why this spread on the right gives you a higher options play score. And if you're ready to place that trade and you see that this trade is the one that you want to make, you can hit that trade button. As you can see, the strategy checklist here is all green, meaning everything is working in your favor. The stock is trending in your direction. The market is trending in your direction. The options play score is good. There's no earnings between now and expiration. The spread and liquidity of this option looks good. So once you do is you hit the preview order button. It'll pre-fill all the order tickets for you so that you don't have to preview anything. You can simply put in the price and click on preview order for execution. Okay, I don't have a lot of time here. I want to try to give you guys as many examples as possible so that you actually see how we use this platform. And as you can see, I can go through so many stocks and quickly identify what is some viable option strategies for you without doing a lot of work. And any of you that have spent any time using these types of pages will know that a lot of times you spend a lot of manual work trying to find different strike prices, different expirations. And a lot of times the first try, you just don't find the right call or put, and you end up coming back and forth to these types of pages all the time. What we wanted to do is show you a tool. So if you don't want to trade the Julys, you want to trade the August, you just change that thing. Or if you want to move the strikes up or down one, you just move that. And all the analysis that we show you is done in real time based on the strikes that you change. So if, let's say you want to make this vertical narrow or wider, you can do all of that just by the click of a mouse. Or if you want to move all the strikes up one or down one, you can just do that all by the click of a mouse. And that's really what the power of this tool is. It allows you to explore and play around with options and not feel burdened by the option chains. So let's just take a look at one last example here. Here's a trade. I took TLT, 20-year Treasury ETF, very popular these days. This, as you can see, the Treasury ETF crossed below its to a 50-day moving average here today. So maybe you're bearish on this because it crossed below its moving average. So maybe let's take a look at some bearish opportunities. So I'm clicking on I'm bearish. Now you can see if you can short the stock, you can buy a put, you can buy this put spread. The thing about moving averages is that it really doesn't give you a target. But the thing is that you can actually use other things as your target. So for example, as you can see, the stock bounced off this 117 level back here in late April, bounced off of this 116 level back in May. So 116, 117 is possibly a target that you might want to use when you're bearish on this trade. So you can actually combine different forms of technical analysis to help provide an outlook. So the moving average may provide you with the bearish outlook, and then maybe the support levels provide you with that target. You might still want to buy this put spread. So you buy the 119 put, which gives you that bearish move, and then you sell the 115 put against it to help pay for some of that cost. So instead of paying $170 for an outright put, you're only risking $136 to take the same bearish outlook on TLT. So as you can see, if the stock does move down to this 116 level, if you had shorted the stock, you make a 2% return. If you bought this put, you make a 76% return. If you bought this put spread, you're looking at about 120% return. And vice versa. What happens if TLT reverses and goes straight up in the next few days? So if it goes up to 122, here, if you shorted the stock, you lose $336. If you bought this put, you lose $170. So half the risk that you're taking when you're buying shorting the stock. Or if you bought this vertical here, you're only risking $136, the least amount of money. And that's really why this strategy here on the right gives you the higher options play score and is the most popular amongst professional traders. Professional traders will typically always trade spreads versus just buying a call or a put most of the time because it helps offset their risk. They're risking substantially less money to potentially make a higher return. And that's really why these professionals will typically more likely trade these spreads versus just outright buying a put or a call. And if you agree with this types of analysis and you choose that this is one you want to trade, you can click on the trade button, preview order, and it sends it off for you so that you don't have to fill out any tickets manually. So with that, what I'm doing is I just want to sum up real quick. For those of you that are brand new to options, I highly recommend you to take a look at the options wizard, which you can find under the options tab under your trading tab. Click on the options wizard tab. That will bring up this tool. It's free of charge for all of you. So even if you're brand new to trading options and you're not familiar with options trading or technical analysis, please take a look. This is designed to make your beginner's life much, much easier compared to having to pull up this chain and stare at these wall of numbers and trying to figure out what is what. That's really difficult for beginners, and I understand that because I went through that pain process myself, trying to figure out what all these numbers mean. And once you figured out what all these numbers mean, trying to figure out which one to choose is still a difficult proposition. So what we do is we provide you with starting points. All you have to do is type in the stock. Doesn't matter what stock it is. You have two options. You can click on I'm bullish, or you can click on I'm bearish. I will actually be doing another webinar soon talking about the different indicators we have here, the 1 month and 6 month trend indicator, as well as our technical score, which helps provide you with another directional view. This is all based on my work as a technical analyst to create these indicators for you, and that will help also provide you with some directional guidance. So for example, if you're bearish on Johnson & Johnson and you agree with our indicators, this tells you that this is a weak stock, it's trending bearish. So you might want to look at some bearish strategies, and we present you with 3 bearish strategies that you can take if you also agree with our analysis. So please make sure that you take a look at options play. It's free of charge to you, and once you could do your analysis here on our charting package, and then once you're ready to place the trade, remember, click on the trade button, and when you hit the preview order button, it pre-fills your ticket so that you don't have to do it yourself manually. So with that, I just want to thank everyone for coming this afternoon. And at this point, what I will do is I will open this up for Q&A so that you guys can ask any questions you have. I have a question here saying, can you give an example of GE? Okay, let's take a look at GE. So GE is trading at 1364. As you can see, this is a very weak stock, meaning it's underperforming the overall market. The 1 month and 6 month trends are bearish, meaning it's trending lower. As you can see, it actually just entered this bearish trend just a couple of days ago. So this is a relatively new bearish trend. And what's noticed, to my eye, 14 was kind of a level that this stock reacted to. As you can see, when it bounced off its lows, it went up to 14, bounced lower, broke above 14, so then that resistance levels turned into support. So when it came back to this 14 level, it kind of bounced higher. And then it came back down to 14, bounced a little higher, fiddled around with it, and then finally broke below it. So this was kind of more of a breakdown trade. So I see 14 as kind of a support or resistance level. Recently just broke down below that support level. So I would be looking at maybe some bearish strategies, and I would target this downside target of roughly about 12, a little under $13, $12.75, roughly that area. So what I'd be looking at is maybe buying a put or a put spread here. So if the stock goes down to that 12.75 level that I was just talking about, here, if you had shorted the stock, you make a 6% return. Buying a put gives you a 45% return. Buying the spread gives you a 76% return. So if the stock moves down to this 12.5 level by expiration, which I actually think should probably happen a little quicker. So for example, if you think the stock's going to move down to 12.75, maybe in a few weeks, let's say by the end of June, maybe before the July 4th weekend, if that stock moves down to 12.5, then you make a 68% return on this vertical. An interesting strategy to look at. So that's my views on GE. Again, this is simply just for illustrative purposes and to show you how you can utilize technical analysis with options play to quickly find an option strategy to trade for your views. This is not a solicitation to trade GE or any of its options. Ron's asking, can we see an example of trading a market index option? So sure, I don't want to get too far out of the realm of things, but let's take a look at trading NASDAQ. So let's say you were looking at NASDAQ 100. You would look at the same way you would look at any stock. Maybe let's look at QQQ, which is another proxy for the NASDAQ 100. I think this is probably something where most people actually have the ability to trade. So as you can see, the Qs, which is the NASDAQ 100 index, as you can see, it recently broke to a new 52-week high, printed a new 52-week high. This is what I would consider a breakout. So you might want to take a look at buying a call or a call spread. You can do them on the Qs, you can do them on NDX, you can do them on SPX, or any of these you can use for this specific strategy. What is net price means in the order form. When utilizing Options Wizard, will it automatically provide the net price? So what we tell you is the current bid ask. So as you can see, this QQQ 175, 174 call vertical is trading at 333 by 346. So when you place that order, you can choose where you want to be on that, right? So as you can see, you might want to put a debit at 346, or you can modify this. You can say, I think it's going to maybe, you might want to place it at 345 so that you can get a 1 penny price improvement. So that's up to you as to how you want to, but we will fill out the net price for you based on the current bid ask. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out this afternoon. I hope you guys have found this useful. If some of you that are using option chains, I know I was using option chains for a long time, and it's really difficult sometimes to move away from it. But I promise you, when you get more used to using options play, you will find that it's a lot more useful. And the chains are great, but what they don't provide you with is the ability to compare a call to a call spread. You can only compare one call to another call, and it's even difficult to compare one expiration to another expiration. So that's really where the benefit of having options played comes in, because you could put 3 calls next to each other or 3 call spreads next to each other and actually really compare the 3 and say, what happens if the stock goes higher? What are my expected returns for each one of these strategies? Our P&L simulator calculates it down to the penny, so you know exactly which strategy gives you the best return for your given outlook. So thank you so much for attending this afternoon. We'll be back in a couple of weeks to do more webinars for you guys. I hope you guys have found this useful. Thank you for attending, and I'll see you guys in a few weeks. Have a great afternoon.